The Social Security Administration just announced your 2026 raise, and on paper, it looks great. Politicians are celebrating it. The news headlines are calling it relief for seniors. But if you actually do the math, the real math, the math nobody on TV is showing you, most retirees are about to discover something shocking. The raise you're being promised is not the raise you're going to receive. Because before that COLA increase ever touches your bank account, Medicare is going to take its cut. The IRS may take another. Your state might take a third. And by the time everything is deducted, millions of seniors are going to open their January deposit and realize their actual raise is barely enough to cover one tank of gas. In the next few minutes, I'm going to show you the official 2026 COLA number. I'm going to walk you through exactly how Medicare Part B premiums are going to eat into it. I'll expose the income thresholds that trigger an extra Medicare surcharge most seniors have never even heard of. And near the end of this video, I'll show you the one strategy thousands of retirees are using right now to legally protect more of their COLA from being clawed back. If you're collecting Social Security or about to file or helping a parent, you cannot afford to miss this. Hit subscribe right now if you're over 60. This channel exists for one reason: to decode the benefits you've already earned, in plain English, before Washington quietly takes them back. All right, let's get into it. So let's start with the actual number. The 2026 Cost of Living Adjustment, or COLA, is the percentage by which Social Security increases your monthly check to keep up with inflation. It's announced every October by the Social Security Administration, and it kicks in starting with your January deposit. For 2026, the COLA came in at roughly 2.5%. Now, for some of you watching, that might sound okay. For others, it sounds disappointing. And here's the truth: it's both. Let me show you what 2.5% actually means in real dollars. If your current Social Security check is $1,800 a month, a 2.5% raise adds about $45 a month. If your check is $2,500, you're getting an extra $62. If you're at the top of the scale at $4,000, you're getting around $100 more. Sounds fine, right? Until you understand what's about to come out of that raise before you ever see it. Here's the first deduction nobody talks about clearly: Medicare Part B premiums. For most seniors, Medicare Part B is automatically deducted directly from your Social Security check before it ever lands in your bank account. You don't pay it separately. You don't write a check. The government just takes it. And every single year, that premium goes up. For 2026, the standard Medicare Part B premium has increased, and the increase is significant. We're looking at a jump of roughly 6 to 8% on the Part B premium, depending on the final number. So even though your Social Security check went up by 2.5%, your Medicare premium just went up by nearly 3 times that percentage. The math is brutal. If your Social Security raise is $45 and your Medicare premium increase is $15 to $20, you've already lost almost half your raise before January 1st. And here's where it gets worse. Because of something called the hold harmless provision, in years where Medicare premiums rise faster than Social Security, lower-income seniors are partially protected, meaning some of you won't see the full premium increase. But, and this is critical, if you're a higher earner, or if you're new to Medicare, or if you pay your premiums directly instead of through your Social Security check, hold harmless does not apply to you. You eat the entire premium increase, every dollar of it. Now let's talk about the second deduction most seniors don't see coming. It's called IRMAA. That stands for the Income-Related Monthly Adjustment Amount, and it's one of the most aggressive surcharges in the entire Medicare system. Here's how it works. If your modified adjusted gross income from 2 years ago was above a certain threshold, and in 2026 that threshold starts at around $106,000 for individuals and $212,000 for couples, you don't pay the standard Medicare Part B premium. you pay a surcharge on top of it, and the surcharge is steep. At the lowest IRMAA bracket, you pay an extra $70 to $80 a month on top of your standard Part B premium. At the highest bracket, you can pay over $400 extra per month, per person. So a couple in the highest bracket could be paying nearly $1,000 a month in Medicare premiums alone, most of it deducted straight out of their Social Security checks before they see a single dollar. And here's what makes IRMAA so painful. It's based on your income from 2 years ago. So if you had a one-time event, you sold a house, you took a Roth conversion, you took a big IRA distribution, you received an inheritance, that one event from 2 years ago is dragging your premiums up today. And there's almost no way to undo it after the fact. But there is a way to fight it on the front end. If you've had a life-changing event, retirement, the death of a spouse, divorce, loss of pension income, you can file Form SSA-44 with the Social Security Administration and request that they recalculate your IRMAA based on your current income, not your income from 2 years ago. Most seniors have never heard of this form. Most financial advisors don't bring it up. But for the right person in the right situation, filing SSA-44 can save you thousands of dollars per year. Write that down. Form SSA-44. Now let's move to the third bite out of your COLA. Federal taxes. Yes, your Social Security can be taxed, and the rules that determine how much get triggered by something called provisional income. Here's the simplified version. Take your adjusted gross income, add any tax-exempt interest, and add half of your Social Security benefit. That total is your provisional income. If you're single and that number is above $25,000, up to 50% of your Social Security can be taxed. Above $34,000, up to 85% becomes taxable. For couples filing jointly, those thresholds are $32,000 and $44,000. Now here's the part that should make every senior watching this furious. Those thresholds, the $25,000 and the $34,000, were set in 1983. They have never been adjusted for inflation, not once, in over 40 years. So every single COLA you receive pushes more of your benefit across those thresholds, which means every raise Congress gives you with one hand, the IRS quietly takes back with the other. In 1983, almost no retiree paid taxes on their Social Security. Today, more than half of all recipients do. And by 2030, at the current pace, nearly every retiree in America will be paying federal taxes on benefits they already paid taxes on while they were earning them. It's one of the great quiet betrayals in American retirement policy. And it's why your COLA never feels like it goes as far as the headlines suggest. Now let's talk about the fourth bite, state taxes. There are still states in America that tax Social Security benefits at the state level, even after the federal government has already taxed them. The list has been shrinking, but if you live in one of these states, you may be paying state income tax on the same dollars twice. Some states fully tax it. Others partially tax it based on income. Others give exemptions if you're below certain thresholds. If you live in a state that taxes Social Security and you're nearing retirement, this is a moment to seriously consider what your retirement state is going to be. The difference between retiring in a state that taxes Social Security versus a state that doesn't can be $10,000 to $15,000 per year for a middle-class retired couple. Over a 25-year retirement, that's $250,000. Same income, same lifestyle, different zip code. So let's pull this together. Your 2026 COLA is roughly 2.5%. Out of that raise, Medicare Part B takes a bite. IRMAA may take a much bigger bite if you're above the income thresholds. Federal taxes can claim up to 85% of your benefit if your provisional income crosses outdated 1980s thresholds. And state taxes, depending on where you live, can take another piece on top. By the time it all settles, the average middle-class retiree is keeping somewhere between 40 and 70 cents of every dollar of their COLA increase. The rest is gone before it ever lands in your bank account. Now, I promised you at the beginning of this video, one strategy thousands of retirees are using right now to legally protect more of their COLA. Here it is. It's called tax bracket management through Roth conversions before age 73. Stay with me because this is powerful. The biggest reason your Social Security gets taxed is because of the income coming out of your traditional IRA, your 401k, and your required minimum distributions starting at age 73. Those withdrawals raise your provisional income, which pushes more of your Social Security into the taxable zone, which often pushes you into a higher IRMAA bracket, a triple hit from a single source. The strategy is to convert portions of your traditional IRA into a Roth IRA before you start required minimum distributions. You pay taxes on the conversion now, at today's rates, in your current bracket. But once those dollars are in the Roth, they grow tax-free. They come out tax-free. They don't count toward your provisional income, and they don't trigger IRMAA. Done correctly, over a 5 to 10 year window between retirement and age 73, a Roth conversion strategy can permanently shield tens of thousands of dollars of your COLA every year for the rest of your life, from federal taxation and Medicare surcharges. This is not a do-it-yourself project. The math has to be run carefully, year by year, watching your tax brackets, your IRMAA brackets, and your provisional income threshold simultaneously. But for the right retiree, typically someone between 62 and 72, with significant traditional IRA balances, this strategy is one of the highest leverage moves in all of retirement planning. Here's what I want you to do this week. 3 steps. Step 1. Pull your most recent Social Security statement and your most recent Medicare premium notice. Add them up. Calculate exactly how much your raise is in dollars and exactly how much your Medicare premium increase eats into it. Step 2. Pull last year's tax return and calculate your provisional income. If you're above the federal taxation thresholds, you need to be having a tax planning conversation, not just a retirement planning conversation. Step 3. If your income from 2 years ago was unusually high because of a one-time event, look up Form SSA-44, fill it out, and file it. It's free. It takes an afternoon, and it could lower your Medicare premiums by hundreds of dollars a month starting almost immediately. Look, the truth is your COLA was never designed to make you wealthy. It was designed to keep you from falling behind. And in 2026, with Medicare premiums rising faster than benefits, with IRMAA brackets catching more middle-class retirees every year, and with federal tax thresholds frozen in 1983, the math is working against you whether you realize it or not. The only people winning are the ones who understand the system well enough to plan around it. That's what this channel is here for. If this video helped you understand what's actually happening to your raise, do me 3 quick favors. Hit the like button so YouTube pushes this to more seniors who need to see it. Subscribe so you never miss the next decoder. And share this with your spouse, a sibling, or a friend over 60. Because the people who hear this first are the people who still have time to act. In the next video, I'm breaking down the 7 states that still tax Social Security in 2026, ranked from least painful to most punishing, and showing you exactly which ones to avoid if you're planning where to retire. Make sure you're subscribed so you don't miss it. I'll see you in the next one.